Somewhere in America right now, someone is paying off their credit card in full, on time, every month, no interest, no late fees. By every rule the bank ever gave them, they are doing everything right. And the bank is still making money off them, not a little. Some of the most profitable card products in the country are built specifically around customers who never carry a balance at all. For years, the story most people have been told is simple. Credit card companies make their money from people who mess up. Late payments, high interest, debt that spirals. That story isn't wrong. It's just missing 2/3 of the picture. Because behind every swipe, there's a second transaction happening, one that has nothing to do with you paying the bank, and everything to do with someone else, paying the bank just to reach you. By the end of this, you'll understand exactly where the money actually comes from, and why the customer who never pays a cent in interest might be one of the most valuable customers in the entire system. That's the kind of thing this channel exists to expose. The mechanisms in your financial life that are built quietly and legally to stay invisible. Subscribe, because what this file uncovers next only gets stranger. Here's the assumption almost everyone starts with. A credit card company is essentially a lender. They give you a line of credit, and if you don't pay it back fast enough, they charge interest. Simple. That assumption isn't false. For the large share of American cardholders who carry a balance month to month, interest is a massive part of the picture. We'll get there. But that assumption treats the credit card like it has one customer. You. It doesn't. A credit card is a three-sided arrangement, and you're only one point of the triangle. The other 2 points are the merchant standing behind the register and the card network sitting quietly in the middle of every transaction. Invisible, unless you know exactly where to look. Pull on that thread, and the entire business model changes shape. Before we go further, we want to know something specific. Have you ever paid your credit card in full every single month and still wondered how the company makes any money off you at all? Tell us in the comments, because the answer most people give us is the exact blind spot this video is about to close. Start with the part almost nobody notices. The merchant. Every time a card is swiped, tapped, or entered online, the store selling you that coffee, that flight, that pair of shoes, pays a fee just to accept it. It's called an interchange fee. And on the average credit card transaction in 2025, it ran a little over 2% of the purchase. Picture an ordinary small business, a hardware store, a bakery, doesn't matter which, where card processing quietly becomes the third largest line item on the monthly statement, right behind payroll and rent. Not fraud, not a mistake, just the ordinary cost of letting people pay with plastic. At first, this seemed harmless, a couple of percentage points, absorbed quietly into the cost of doing business. But multiply that across nearly every card-accepting business in the country, and in 2025 alone, American merchants paid out roughly $118 billion in credit card interchange fees, a figure that has more than quadrupled since 2009. That's not a rounding error in a corporate ledger. That's money moving from Main Street to Wall Street on every single swipe before you've ever missed a payment. And here's the part that reframes everything. That fee gets charged whether you carry a balance or not. The customer who pays off every statement, on time, without exception, is still generating revenue every time they tap their card. They're not the exception to this business model. In a lot of ways, they're the ideal customer, someone the bank never has to worry about defaulting, who still triggers a fee with every purchase. But here's what the receipt never tells you. That fee has to come from somewhere, and merchants don't absorb it forever. They build it into the price of the coffee, the flight, the shoes, the price everyone pays, regardless of how they're paying. Researchers who've studied this exact transfer estimate it moves somewhere around $30 billion a year from cash and debit users toward the rewards earned by credit card users. And because reward card ownership rises with income, a real share of that money flows quietly from lower and middle-income households up to higher-income ones. Nobody voted on this. Nobody signed a form agreeing to it. It's just how the math settles, invisibly, On every receipt in the country, a credit card doesn't have one customer, it has 3, and only one of them is you. If this is already changing how you look at your own wallet, hit like. We're just getting started. That's Engine 1, and this is where the story takes a darker turn. Roughly half of American cardholders carry a balance from month to month. The industry calls them revolvers. For them, a second, far larger profit engine switches on: interest. The average rate on a balance currently being carried sits above 21%. Not on payday loans, not on subprime products, on ordinary credit cards, sitting in ordinary wallets. Run the math on that, and it stops sounding like a small percentage. Take a balance of $5,000 at roughly 22% APR and pay only the minimum. That debt doesn't clear in 1 year, or 3, or 5. It can take close to 2 decades to disappear. And by the time it does, the total cost can run past double the original $5,000. That's not a rounding error. That's a second mortgage's worth of money, extracted a few dollars at a time, disguised as a minimum payment. The minimum payment isn't a mistake. It's a calculation, built to keep the balance alive, just long enough to keep the interest compounding. Buried inside that structure is something the Credit Card Act of 2009 tried to fix, and only partly succeeded at. That law banned some of the worst practices of the era: retroactive rate hikes on old balances, fees charged without real consent. What survived is a fee structure that still runs quietly underneath everything: late fees, annual fees, foreign transaction fees, and cash advance fees, which start accruing interest the instant the transaction happens, with no grace period at all, each one small enough on its own to avoid outrage. All of them together, adding up to billions more, stacked directly on top of interchange and interest, until one detail changes everything. None of these 3 engines compete with each other. They run at the exact same time, on the exact same card, feeding off completely different behaviors: spending, carrying, and slipping. So here's the real answer to the question this video opened with. Credit card companies don't make their money primarily from people who fail. They make it from volume, from every merchant fee, on every swipe, from every person, responsible or not. Interest is the loudest revenue stream. It isn't the only one. And for a growing share of the industry, it isn't even the largest. There's a 4th engine, quieter than the rest. When a balance finally goes unpaid for good, the debt doesn't just vanish as a loss. It gets charged off the books and sold, often for pennies on the dollar, to collection agencies who then pursue it themselves. Even the failure is a transaction. Even the ending gets monetized. Every swipe pays someone. The question was always, who? This is why prices at the register rarely change based on how you pay, even though the store pays more to process a card than it does cash. It's why rewards cards keep getting more competitive, even as issuers report record profits. Because of how interchange gets folded into retail pricing, researchers estimate the average American household now pays over $1,000 a year in hidden costs tied to swipe fees. Money spent at checkout, never itemized, never explained. You've probably noticed prices creeping up over the last few years and blamed inflation. Some of that creep has always been this. Imagine someone who's always assumed their cashback card was free money, until they noticed the exact same items cost more at stores that had to build interchange fees into their prices. The cost doesn't disappear, it just moves somewhere you don't see it. To be fair, this isn't some grand conspiracy to make people fail. A default is a loss for the bank too. And interchange revenue does fund real things: fraud protection, instant authorization, the rewards programs people genuinely enjoy. What's actually happening is subtler, and in some ways, more unsettling. A system engineered, quietly and legally, to make the most profitable version of you look identical to an ordinary, responsible financial life. None of this means credit cards are something to avoid. Used well, they remain one of the more powerful tools available for building credit, and even earning genuine value back. But used well means understanding which engine you're standing in front of at any given moment. Pay your statement balance in full whenever you can. The interest engine never touches you. Though remember, the grace period only covers purchases, never cash advances or balance transfers, which start charging immediately. If you're carrying a balance, checking your actual APR in the cardholder agreement, not the number from the marketing email, is the single most powerful move available to you. And if you're chasing rewards, it's worth asking honestly whether what you earn back genuinely outweighs what you're likely paying elsewhere. Because a low minimum payment was never a sign the debt is manageable. It was a sign it's designed to last. So think back to that person from the beginning, paying in full, on time, doing everything right. They were never being punished by the system. They were just finally seeing it. The card doesn't need you to fail. It just needs you to keep swiping. You, the merchant, the network. Once you see the triangle, you can't really unsee it. The swipe was never just a swipe. It was always the opening move. So tell us, before this video, did you know merchants pay a fee every time you swipe, even if you never carry a balance? Let us know below. Let's compare notes. Next time, we open a different file, one built entirely around a single number on your statement. That looks small, feels harmless, and is quietly calculated to keep you in debt for as long as legally possible. The minimum payment trap. And once you see how it's actually built, you'll never look at that button the same way again.